Hello everyone, welcome to the channel. In today's video, we are going to understand the basics of stock market and how to analyze a company using fundamental analysis. If you are a beginner, don't know where to start, this video will help you build a strong foundation. So before we go into the analysis, there is a small disclaimer. So this video is only for educational purposes. It's not a financial advice or a stock recommendation. So first thing, what is a stock market? So a stock market is a place where people buy and sell shares of a company. So when you buy a share, you're not just clicking a button, right? You're actually becoming a part owner of the company. But you can't make any decisions on behalf of the company. You're just owning the stock of a company. That means you are owner of the company on the paper. Now, most of the investors lose money because they buy stocks without understanding them. The difference between losing money and building wealth is very simple. You just learn how to research a stock before investing. So there are 10 golden investing rules that you should follow to get succeed in stock market on the long run. So first one is invest in your surroundings. This means invest in companies you understand and you see potential on the long run. And second one, do not try to predict the market. Nobody can perfectly predict short-term falls or rises, not even the expert. The market reacts to elections, global events, interest rates, economic data, and emotions. So, trying to time the perfect buying moment leads to stress and bad decision. So, instead, invest regularly. Third one is be patient. Stock market wealth comes slowly. Good companies need time to grow. Fourth one is be disciplined. Discipline means having a plan, sticking into it, not buying because of FOMO, fear of missing out, not selling because of fear. So, fifth one is power of compounding. So, as we all know, compounding means earning return on your return, right? When you get any profit, so instead of liquidating that profit, you reinvest in other stock to get more returns. So that is power of compounding. And the next one is buy when others are fearful. So when market crashes or everyone is panicking, strong companies become cheap. So that is the time you buy. So the perfect example is COVID crash. So at the time of COVID, everyone was very fearful and they sell all their portfolio, all the stocks. Then the stock prices fell very drastically. So when you invest at that time, right now the market is at all-time high. So you would have get more returns. So sell when others are greedy. So whenever everyone becomes suddenly expert and blindly buys, then prices go too high. So at the time you sell the stock. Now continue learning. So the market keeps changing. If you stop learning, you stop earning. Learn how to read financial statements, economy basics, sector analysis, business model, risk management, and psychology of investing. So don't worry, those things, those terms, you will be getting more understanding or more familiar on my YouTube channel. Now, so there are two types of analysis. One is technical and another is fundamental analysis. So technical analysis means analyzing statistical and historical price behavior. It's for short term. Now fundamental analysis is mostly for the long term perspective. So it's based on the present and future cash flow, earning results, competitive factors, and macroeconomic outlook of a company. Now there are few key elements of a fundamental analysis. So first one is revenue and profit growth, debt levels, cash flow and free cash flow. There are some valuation metrics, competitive advantage, promoter and institutions holdings, earnings growth, and EPS trend. So let's talk about each metric in detail. So the first one, revenue and profit growth. So what is meant by revenue? It's revenue means total money the company earns, right? And the profit, money left after the expenses. So a strong company shows consistent growth over multiple years. So here you can see an example, ABC company. So each year the revenue is increasing drastically, gradually, and the profit is also increasing gradually, right? So this upward trend shows the business is growing and demand is increasing. So this is where you buy a stock. Second one is debt levels. So debt helps companies grow, but too much debt increases the risk. So we have a parameter called debt to equity ratio, and if any for any company which is having debt to equity ratio is below 1, that means it's good company. It's handling their debt very carefully. And if the debt to equity ratio is more than 1.5, little high risk, right? Now the third one is cash flow and free cash flow. So cash flow means it's a profit on paper. Does not mean the company has a real cash. Company has a cash but on the paper, right? Whereas free cash flow shows how much actual cash is left after expenses and reinvestments made by the company. So for example, ABC company generates 200 crore profit, but on the paper it generates only 200 crore profit, but after expenses, after reinvestments, everything, the company free cash flow is 140 crore, right? This means the company has strong operational efficiency and financial flexibility. And fourth one is valuation metrics. So valuation tells whether the stock price is fair, cheap, or expensive. So there are some common metrics one should aware before investing to a stock is one is PE ratio, and another one is PEG ratio, third one is price to book ratio. So we'll get more detail later on this video. Now for example, two companies have same profit, but one trades at very high PE. This means the market expects fast growth of that company or the stock is overvalued. So the goal is to avoid overpriced stocks and identify fairly valued ones, because at the time of crash, the stock which is having more PE will crash more than the stock which is having medium PE. Now next one is competitive advantage. We call it as moat. Moat protects a company from the competitors. So there are several types of moat. Strong brand. A company may have patented products, superior technology, company has large distribution network, cost advantage, and monopoly or exclusive rights. So if ABC company sells a product everyone uses and competitors cannot easily replace it, that's a moat. So if any company is doing any work, right? For example, if that work or if those products can easily uh, done by any other person, that means there is a chance of more competition for that company. If more competition in the market, obviously there will be some less revenue of that company. So a strong moat implies long term survival. Now another factor is promoter in this institutional holdings. So promoter is nothing but the owner of the company, right? If the company has high promoter holding, which means promoter have some confidence on the company. And we have other institutions called FOI and DII, foreign institute investors and domestic institute investors. So if a company have more FII and DIA, that means it's a positive signal. More investors are coming to the company. So if I talk about order book, we have another parameter called order book. So order book shows the work or products orders already received from the customers but not yet delivered. So it includes project in pipeline, pending product deliverables, and confirmed upcoming revenues. And we have EPS, earnings per share. So EPS tells how much profit the company makes for each individual share. So EPS equals to net profit divided by total number of shares. For example, if a net profit of a company is 100 crore and there are 10 crores shares, then EPS will be 100 divided by 10, which is 10. So the higher EPS, the better performance of the company. Now we have another parameter called PE ratio, price to earnings ratio. So PE compares the current stock price to its EPS. It tells how much investors are willing to pay for 1 rupee of earnings. For example, if if the stock is trading at 1, so investors are willing to pay 20 rupees. So in this example, if stock price is 200 and EPS is 10, so PE calculates stock price divided by EPS. That means 200 by 10, which implies 20. That means if stock is trading at 1 rupee, investors are willing to pay 20 rupees to company. So high PE means expectations of the future growth are overvalued. Low PE means undervalued. So with that said, we'll just uh, go to the screener.in to see some fundamental analysis of a stock in action. So I have one company called TCS. So here you can see if I go to the peer comparison, so TCS is sits in first place in terms of market capitalization. Now let's go to quarter results. So you can clearly see the sales of the company is increasing quarterly from June 2023 59,692 to 65,836 61,237 62,613. So till September 2025 it's 65,799. So steady increasing the number of sales in each quarter. That implies it's a good company. Now in terms of net profit as well, its net profit increases every quarter, and EPS also you can see clearly increasing every quarter. And we have profit and loss statements. So you can see sales increasing every year, which is a good sign. So when you look into the profit and loss statements, there are few parameters you must check. So one is sales, second one is EPS, and operating profit. So these three parameters are very important when you look into the profit and loss statement. So you can clearly see sales has been increasing year on year basis, and operating profit as well increasing on year on year basis. This implies company is in good shape to invest, and even net profit is also increasing year on year basis. Now we have another metric called balance sheet. So here in this balance sheet, you look into the equity capital, the reserves, borrowings, and total assets. So reserves means how much cash they have in their reserves. So you can clearly see the reserves has been increased in year on year basis, and borrowings means the loans they took from the banks or from the investors or from other third party. So you can see increase in borrowings. So increase in borrowings, that doesn't mean the company is in bad shape. So it's like how they handle their borrowings. Now in the end we have total assets. You can see total assets has been increasing year on year basis, which is a good sign to a company. Then we have another important metrics, shareholding pattern, right? So the promoter of the company, you can see year on year there is not much decrease on the promoter holding. So 71% promoter holding, which is a good sign. Anything above 50% promoter holding is a very good sign for the company. That means promoter has confidence in their company. That's why they kept 71% of the shares to themselves so that they can benefit in the long run. Now FIIs, foreign institute investors. So you can see clearly there are some portion of the shares has been invested by the foreign investors. That means the fund managers from the other outside India. So they are very much interested in buying this stock. And you have another person called DIS, Domestic Institute Investors. These are the mutual funds who sits in India and manages the SIPs from the common people. And we have public. Public means the common investors. So less public in interested company will have a good advantage, because if you see a company which is having demand on public, that means if any fear comes out, all the public investors will dump the company, so which leads to sudden fall on the company's stock price. So this is how you check the fundamentals of a company. So hope you enjoy my video. So please like and subscribe to my YouTube channel for better and more videos like this.